As of the end of August, real-time data on U.S. consumer spending showed that people were spending about 7% less on average than they had been 1 year earlier. Spending was particularly hard hit in the highest income areas. The reluctance or inability of consumers to spend money contrasts with equity markets, which were hitting record highs in late August, before correcting in the early days of September. The divergence between equity prices on the one hand and consumer spending on the other has given rise to a narrative that the stock market has decoupled from the real economy. The answer, however, might be more complex. The S&P 500 and the Russell 2000 have actually tracked real-time consumer spending data quite closely since the beginning of the year. Among the equity indices, only the Nasdaq 100, which is dominated by large technology firms, has truly peeled away from the real-time economic data. The Nasdaq's rally, like the sharp upside moves in gold and silver, may also have been fueled by the expansion of central bank balance sheets. Since the beginning of this year, the Bank of Japan, the European Central Bank, the Bank of England, and the U.S. Federal Reserve has dramatically expanded their balance sheets through quantitative easing. The money that they have created went directly into their respective bond markets. As bond yields plunged, that made other investments like precious metals and technology stocks look more attractive by comparison, and may have indirectly pushed money into these other asset classes. What is important to know, however, is that some of the central banks pulled back on quantitative easing at the end of the second quarter. This is especially true of the U.S. Federal Reserve, whose balance sheet shrank slightly over the course of July and August. Does the pullback on central bank balance sheet expansion explain why the Nasdaq, gold, and silver all seem to have run into turbulence so far in September? The answer is we don't know, but investors may be keeping a close eye on quantitative easing actions of central banks for a sense as to whether or not precious metals and technology stocks will continue to head higher. So long as economies continue to improve, the Federal Reserve and its peers may not see much reason to expand their balance sheets further. However, should the economy slow down in coming months, that might encourage them to embark on another round of quantitative easing. I'm Eric Norland, Senior Economist with the CME Group in London.